Hey there, today on the Final Bar, it's Friday, February 24th. Happy Friday. We're going to talk about what happened this week. Yesterday's V-shaped contour to the today, yesterday giving way to the sort of deterioration through the course of today's trading. The S&P and the Nasdaq both finishing lower. Ladies and gentlemen, this is the Final Bar. Hey everyone, happy Friday. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny and clear but cold Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is really optimized to help you try to get your head around markets that are uncertain, markets that are volatile. It's really meant to capture volatility, help you analyze those as a data point. We've had a volatile experience through the course of this week, even though the VIX is still relatively low, not too far above 20. The market has felt certainly choppy and uncertain. Last couple of days in particular, really through the course of this shortened holiday week, you've seen a lot of weakness over strength, but pockets of the market actually holding up quite well, right? Think about insurance companies, think about heavy construction names, semiconductors. These are charts and groups that have actually done very, very well. So we'll try to do our best through the course of today's show to highlight some of the strength and some of the weakness that we've recognized. Let's get into our Wrap the Week segment. I do want to start with a poll. We always have a poll going on our live stream page at StockCharts.com. Also on our social media accounts. So follow us on Twitter and also subscribe to our YouTube channel. We asked you recently, how important is sentiment? Things like the AAII survey, the name exposure index, and others. How important are those in your process? 32% of you said somewhat important. 27% said very important, and then the rest said not so important at all. I actually would have answered where the majority did as well, somewhat important, right? I don't see it as the most important part of my process, but it is an interesting one. As I mentioned many times on the show, I think of macro analysis using charts in sort of three phases, or I guess sort of a hierarchy, right? Most important is price. Second to that is breadth, so confirming price by looking at individual stocks and groups. And then sentiment, because sentiment, broadly speaking, is a little more anecdotal, right? The volatility that we see with the VIX, things like put-call ratios, really based on the options market and looking at live market data to calculate sentiment or to infer sentiment based on positioning. But things like survey data, there's sort of a given, there's a lot of wiggle room, I would say, in those data sets. What's interesting, though, is the longevity. A lot of those surveys have been run for so long that it's very interesting to see how people respond now versus previous bull and bear market cycles. So if you're unfamiliar with some of those things like the name exposure index and others, on the StockCharts platform, there's a little magnifying glass. Click on that and type one of the keywords that you're looking for. Particularly, I would look at Chart School, which is our free educational resource on StockCharts.com. Also, our blog articles, because a lot of our great contributors have posted articles and thoughts using some of those indicators. It might help you get some real-life examples of how they're being applied. Let's continue on our Wrap the Week segment. We like to do the Wrap the Week every Friday. A couple things. First, we'll look at what happened today. Then we'll think about what today means relative to the overall movements we experienced this week. Then we'll finish off looking at some individual groups, some sectors, the S&P itself. Focus, I think, today on the phenomena stocks, sort of those FANG and FANG-like names that very much have been on the move, mostly at a downside through the course of this week. Today, the S&P finishing down about 1%, just above 3970 at the close. Now, to be honest, a lot of that was in the first hour and a half of trading. The S&P actually bottomed out for the day around 11 a.m. Eastern. From there, it's been a bit more of a recovery, but it wasn't really recovering much, right? Sort of that initial gap down was the story. So from there, we've sort of settled in right around 39.70 again. That's down about 1% from Thursday's close. Thursday, of course, we had the big rally in the afternoon. The Nasdaq underperforming the S&P today, with the Nasdaq Composite down 1.7%. Besides Toronto stocks up a little bit in the green, everything else was in the red. Mid caps, small caps, the S&P 100, more mega cap names, all in the red. The VIX pushing higher today by about half a point, up to 2164. And again, remaining above 20 for me means we're sort of in that uncertain volatile label. We get below 20, I think it's more of a low volatility environment, most likely would coincide with a sustained rally in stocks. This week, we sort of had the opposite. We had a bit more of a retrenchment, so volatility naturally kind of pushing higher, because when things are uncertain, when investors get a little nervous, volatility tends to increase, right? That's why it's called the fear index, or I think better the uncertainty gauge is how I like to describe it. Interest rates moving higher through the course of the day today. If you're wondering why the tech trade was down and sort of the FANG sectors, it's probably as good of a reason as any to think about it. Interest rates moving higher basically means that the long-term growth prospects of those growth stocks are less attractive, because you're getting a better, basically getting a better yield from bonds. And so that outperformance you might get from the growth stocks, just their future earnings growth basically is less valuable today. As a result, growth stocks tend to do a little more poorly. And you saw that today with those FANG sectors down, interest rates higher, 10-year yield right around 395 to finish the week. Bond prices, of course, moving lower today, and the dollar index also moving higher. We've described the dollar index at times over the last 12 months as the wrecking ball for risk assets, certainly giving that feel to the tape today, with the dollar stronger and pretty much most of the S&P sectors down today, with one exception, which we'll hit on here in a few moments. Commodities, a little bit mixed as well. Some of the energy portions of the commodity complex doing a little better. So oil prices, natural gas prices higher today. Everything else, though, including precious metals, gold and silver, copper, industrial metals, all moving to the downside. Cryptocurrencies as well, big time in the red, and they sort of really rolled over as the equity market's opening, as the equities are selling off in the morning session. You saw how cryptocurrencies rolled over. So a couple of days ago, Bitcoin up, nearing 25,000. That was sort of the big level we're getting near to. Now all of a sudden we're testing 23,000 as we pull back a little bit. Of course, most of the things we just talked about are closed over the weekend, except for cryptocurrency. Sort of an interesting way to measure. Not a lot of news flow over the weekend, but interesting to see how those things, some of them trade over the weekend. Last weekend, for example, if I remember right, I actually had a pretty nice move to the upside. So it might be an interesting chart to watch over the weekend. Ether just above 1,600 and Bitcoin around 23,200. I want to look briefly here at the sectors. So as I mentioned, only one of the S&P sectors actually really finishing firmly in the green. That was the materials sector, up 0.7%. Financials, utilities, energy, all basically right around that zero level. Everything else underperforming, and some of them to a pretty significant degree. Real estate down 1.8%. That was the worst performing sector. The next three from the bottom are a lot of market cap in these sectors: technology, consumer discretionary, communication services, all down 1.3 to 1.8%. So when those sectors are having that kind of move, there's really no chance that our major growth-oriented benchmarks are going to finish anywhere but kind of in the red. And just briefly, I'll show you the phenomena stocks. We're going to look at a little more detail if we have time at the end here, but Meta was the best performer out of these 8 names, down about 1%. Adobe getting hit pretty good, down almost 8% through the course of the day. Microsoft, Apple, two of the biggest names in the U.S. markets, Amazon and others, all down pretty good, about 1.5 to 2%. Let's look next at the wrap the week chart. So this is a chart, just looks at the last 5 days, last 5 trading days. We're taking Monday off for the holiday this week. So we're starting the clock last Friday is closed on the 17th. Then we have Tuesday through Friday of this week. At the end of the week, stocks in the form of the S&P 500 down 2.7%. So not a great week. For sure. And of course, Tuesday was a big down day. Today, a big down day as well. After that, you had Wednesday and Thursday, which actually weren't too bad. Sort of flat to up a little bit. But Tuesday and Friday really giving the bulk of the deterioration for the equity markets. A number of things underperformed the S&P. In purple, we have the small cap Russell 2000 ETF down 2.9%. In pink, the Nasdaq 100 down 3.1%. That's the Qs. In orange, we have emerging markets down 3.5%. That tends to be tied pretty closely to commodity prices, particularly energy, and those having a tougher time this week as a result, that market going down as well. And stronger dollar certainly not helping that trade as well. Bitcoin, the worst performer, down only 5.5%. And I say only because relative to what we've seen at times from something like Bitcoin, it's not nearly as volatile as it has been historically, but every day a down day for Bitcoin. Other things actually outperformed the S&P. Gold was still down, but only down 1.7%. In red, we have the bond prices using the TLT, which is a long treasury bond ETF, down 1.4%. Couple things finished the week in the positive. This is crude oil prices using the USO. Actually managed to finish stronger by the end of the week, up 0.1%, and the US dollar, the best performer, up 1.4%. This particular week reminds me of a lot of what we saw through last year, right? On average week in 2022, kind of felt like this. Stocks were down. Some things were down less. Some things were down more. Very few things were actually positive. And a lot of times it was the dollar up and then everything else down. This is why we call the dollar the wrecking ball for risk assets. I think sort of living up to that moniker this week, with the dollar stronger and everything else kind of moving lower. This shows you what happens when the dollar is really stronger. It's just a lot of times is the ultimate flight to safety, and means that other things are most likely struggling in a pretty big way. Let's look next at the chart of the S&P 500. I feel like we've looked at this in a normal week. We look at it pretty regularly, but particularly this week, I know with a number of our guests, we talked about the chart of the S&P and what it might mean. What's interesting is today we actually traded below the 50-day moving average. We closed below the 50-day for the first time since mid-January. We also broke down through a trend line using the lows from October and December. I think this could be an important one, right? So if you take the low from mid-October, take the intraday low from early January, really connect that to where we were. That's where we bounced down to on Wednesday, and then Thursday we traded below but closed back above. Today we're sort of following through to the downside. So not a great look for the S&P. And at this point, I would say the final two things that are keeping it as this is still a constructive tape. The only things left are, can we hold the 200-day moving average? That's actually an important question mark, I think, for the major averages here. And does the momentum remain positive, right? One of the great tells in the market in late December was the S&P pulling back, making a higher low, and the momentum remaining fairly strong. So the RSI remaining right about 40 at its lowest point. Can we do that same sort of thing here? That would make it the current move look a lot like the drawdown we had in December before we sort of spent some time there and then resumed the uptrend, right? That is a possibility here. We have to see if we can hold that level of momentum. I'm going to be writing an article here shortly for our articles page, particularly about the S&P and some other key stocks looking at their 200-day moving average. I did want to finish off looking at a couple other metrics if we could. Our market trend model is here on my dashboard. There is a change to the model this week. The long-term model really close to turning bullish, but didn't do it. And the sell-off that we had this week was probably the thing that prevented it from turning bullish this week. Certainly was setting up that way over the last month or so, with the model getting more and more closer to that bullish reading on the long-term trend, which hadn't been bullish since back in the second quarter of 2022. Hadn't had a buy signal since the second quarter of 2020 after the March 2020 low. Remaining bearish. Bullish still on the medium term, so recognizing the strength off of the lows, but the short-term model turning negative, and that really represents or recognizes the weakness. So it's, in my book, saying long-term bearish, medium-term bullish, short-term bearish, which is exactly how the chart would feel given the deterioration we saw today. Just to finish off our market recap, I wanted to point out that while the S&P has broken down the advanced decline line, not quite breaking down using a similar trend line analysis off of the lows. That might be something to watch. Also, the 50-day moving average on the advanced decline line. Less than 50% of the S&P members above their 50-day moving average. That's not great, because when that gets below 50%, that starts to get me a lot less confidence in the bull case and a lot more confidence in a deeper retrenchment. You also have the bullish percent index, which gave a key sell signal in early February, now below 50% as well. And consumer discretionary starting to underperform consumer staples through the course of this month. So a lot of charts that had looked very strong, this is a chart I just called the chart, a lot of those metrics either neutral, now it's starting to turn a little more negative, suggesting we're in a period of market weakness. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. We are doing some really cool finishing work in our studio. Hope to be in there very, very soon. A lot of cool things we're planning for the Final Bar through the course of 2023 and beyond. We'll be sharing some of those with you very, very soon. Couple announcements here before we get to our mailbag. First off, our mailbag is fueled by questions from all of you. Shoot us an email with any questions that you have as you're using the StockCharts platform to try to make sense of these markets. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer your question live on the air on Monday's show. Also want to let you know about the upcoming schedule. I'm excited on Tuesday of next week to talk to Chris Verone. Chris is a CMT, he's the head of technical research at Strategas Research Partners, which is a well-respected and followed research shop in the institutional community. I've known Chris and followed his work for many, many years, and I'm excited to see what sort of charts he's sharing with his institutional clients. Also want to let you know our next episode of The Pitch will be airing on Wednesday, March 8th. In celebration of International Women's Day, we're going to have a fantastic all-women panel of fantastic, knowledgeable, and capable technical analysts. Mary Ellen McGonigal, Miss Schneider, and Aaron Swenlin all have been frequent guests and hosts on StockCharts TV. If you go to stockcharts.com/thepitch, you can find more info on that event and also see all of our previous episodes. Some of them have been really thought-provoking with some stock and ETF ideas. Let's continue on our show today with the Final Bar Mailbag. Again, keep your great questions coming. Let's get to question number one. I was asked, which do you give more weight to, the current performance of a sector or the scooter score, the StockCharts technical ranking? And you had a longer question. I just boiled it down into that little bit, but you were mentioning how when you're looking at a list of ETFs, you often will see a discrepancy, I guess, or a disagreement between the scooter rankings and the performance of the sector. And I wanted to bring up my list of the S&P sector ETFs. I'm going to go here to the summary tab, although you can look at other ones. I'm going to sort it on scooter rankings, but you can see I can also sort it on percent change. Now, this is basically telling you a couple different things. The scooter ranking combines a number of different time frames, right? So the StockCharts technical ranking is a proprietary methodology, a model that we created years ago here at StockCharts, combines three different time frames. It's weighted about 10% to short-term fluctuations, about 30% to what I'd call medium-term, and about 60% to more longer term. And that's the reason why you're going to see some disagreement. The scooter rankings are really driven primarily by the long-term trend. So if you have something that has been strong for a while and pulls back in the short term, you could find that situation where the scooter ranking is actually very high, but the percent change on a daily or like on a 1 week basis could look very, very different. You're kind of seeing that here where you have something like financials, which is the top ranked of the 11 S&P sector ETFs. Using our scooter rankings, financials and industrials are really pretty much tied for the top two, followed by materials and energy. But you can see that actually energy was the top performing over the last 1 week, the only sector in the green. The rest of these were all in the red. So what gives? So what you have to remember, again, is that this is geared more toward the longer term return. So this is why I find the scooter ranking so helpful. It's not immune to big movements in the short term, but it's certainly not as weighted, which is a lot of times when you look at individual stocks, you will find some of the top ranked scooter names can actually be down quite a bit on any given day, because it's not just skewed to 1 day's movement. It's trying to take a step back and look more at the forest for the trees, right? More of the big picture. So if you're a medium-term, long-term investor, which is how I describe myself, I think the scooter rankings are a good ranking system in line with the time frame you're probably trying to operate on. But don't forget to look at the short-term movements and then think about, what does it tell me when I have a strong chart, a highly ranked name or ETF that has pulled back and has actually had a pretty rough week? Is it holding support levels? Is it starting to give me a buy signal from something like MACD or PPO? Is it oversold according to RSI in the short term, meaning it's a strong trend and it's pulled back to maybe a more buyable level? That's how you can start to think about the multiple timeframes that are implied by the scooter rankings and some of the other technical indicators. That's how I would answer your question. And again, which one you focus on really is driven by your own time frame. Next question, and thanks so much for that first one. The question was, the Summation Index for the New York Stock Exchange and the Nasdaq Composite have both turned down from a very high level. Is that a bearish tell for the markets? And your comment was, these indexes rarely turn back from high levels as they've done recently, right? Where they went very, very high and then turned lower. To analyze this, why don't we do this? I actually have the Summation Index in my breadth chart list, which is right here. So $NYSI is the NYSE, the New York Stock Exchange McClellan Summation Index. The other ticker that you mentioned was NASI, which is the Nasdaq McClellan Summation Index. I honestly don't look at the Nasdaq version very often. I know it's there, but I just tend to, I have to simplify. I can't look at everything. And so I tend to look at this one because it's a broader, I think represents a broader universe of US equities. Your comment was, here we have the Summation Index. Both of them have had a big run higher. They've both been at some of the highest levels they've been for years and now turning lower. And does that mean, is that a great sell signal? Because it rarely kind of goes back up after it's had a big run and moves lower. Maybe, I guess, is the answer that I would say, right? So with an indicator like this, there are different ways that you can use it. I have found that you think of it in two ways, sort of the leading indicator, an indication that sort of anticipates a reversal or initiates the signal, and then the confirmation, right? What tells you that the signal is actually playing out? One of the other charts, kind of similar idea, is actually the McClellan oscillator. I've highlighted this chart before showing how there are divergences, right? So if you look in January of this year, the S&P was moving higher. The raw McClellan oscillator actually was sloping downwards. That was a bearish divergence there. So that's sort of the leading indicator telling you that this uptrend might be getting to an exhaustion point. But the real signal, the confirmation, is when it goes below zero, because that tells you that the upward momentum is now dissipated, and now it's weakness over strength. So if you look, I think the divergence is more the leading indicator. The confirmation is when it crosses the zero line. I would probably think of it the same way here, right? The fact that the McClellan Summation Index has gone so high and then turned lower, if you look back, there are certainly times when that's been the case, and those have been pretty meaningful pullbacks. But if you look at the last 5 years, for the most part, meaningful pullbacks within longer-term uptrends, right? So the question is this something different? The last time the McClellan Summation Index was anywhere near this high was in August of last year. It turned lower and really never looked back. It almost made a new low for the last 5 years or so. But there's no guarantee. You can see here in early 2021, it kind of came off, sort of rotated back, and the market overall was moving pretty consistently to the upside. So for me, the McClellan Summation Index getting back below zero is the real sign of deterioration. You can see that did not happen in September of 2020. You can see it very much did happen in the first quarter of 2020, in the fourth quarter of 2018, and sort of those big major drawdowns before the 2022 sell-off as well. So, for me, this is sort of the early warning system has been generated, but is there a guarantee it's going to plow below zero and register a significant sell signal? No. So that's why I can't say that that's my most important level. I think for me, crossing the zero level, this is a great chart to sort of measure the big secular shifts from bull phase to bear phase. It's worked magnificently for that over the last 5 years and before there as well. Thanks for that question, by the way, and leading me to think a little bit more about some of the McClellan indicators. Let's get to the next question. What's your usual strategy regarding a stock like Enphase Energy, ticker ENPH, when you see a divergence? Is that a dead cat bounce? Does it mean mean reversion? Should I accumulate for the long term? What gives? And your comment, elsewhere in this in your question, you mentioned it's a great business, but just not a great stock. And I love there's great investment wisdom in the way you actually mentioned that in your question. And I've heard that phrased a lot of different ways. A good company does not always make a good stock. There are plenty of bad times to buy great companies. All of those recognize, and yours as well. It's a great business, but a very bad stock at the moment. What you're doing is recognizing this disconnection between a company or a theme, a narrative, and the stock itself. This is why technical analysis is so valuable. If you're just looking at companies, just thinking about the fundamental stories, just thinking about whether this idea is going to work, you're missing the benefit that it just might not be the right time for that story. This is a relationship we embraced when I worked with institutional money managers. We would actually scan for stocks where the fundamental and technical stories were in agreement, good company, good stock, when they were in disagreement. And a lot of times that would tell us something meaningful, right? Does the market not know about this great story yet? We just need to wait for it to better appreciate, or we wait early? Or are we missing something that other investors kind of recognize, right? There's inherent weakness that we're not pricing in some way, but it can be really instructive. And I think that's why people like Chicken Analytics and others have done a fabulous job of combining the fundamental and technical in a meaningful way. So having said that, your question on Enphase Energy is really talking about the deterioration in the stock. I would agree the long-term potential of a name like this and the idea of renewable energy that Enphase is in the middle of, super powerful. But what the market's been telling over the last 3 months, it's not a really good time for that thesis. It's just not playing out very well. Investors are not treating this well. Now, you can see as we've been making lower lows, as we're below moving average support, we get this potential bullish momentum divergence with lower lows in price, higher lows in momentum. Right now, we're actually making another new low, which means this is a current question mark. I don't know if you could label this a good divergence at this point, because a good divergence means you have a meaningful rally off of that low, and it's clear that the RSI is not going to become oversold again. Because if we would really rotate lower, this can just continue right down. The RSI goes below 30. All of a sudden, the divergence isn't there anymore. So I think still a question mark on this. I think it's an important one to watch RSI, maybe another trend following technique like MACD or PPO, to recognize when the trend is actually shifting. When can you see on the chart that buyers are coming in? Some of the early warnings of like a momentum divergence have signaled, but not the confirmation of a trend reversal to the upside. We need to wrap the show, folks. The 3 and 3. I love those questions, and thank you so much. We have more. We'll get to them on Monday's show, but we got to wrap it today. The 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1, the daily S&P chart. We are keeping it very straightforward here to set you up for success here into next week. When you're preparing for next week and you're thinking about what we learned this week, one of the things I will certainly look at is the fact that the S&P has broken below a key trend line, and I don't take that lightly. One other thing I would notice, I meant to put it on here and I'll draw it real time. You're actually seeing the chart being analyzed before your very eyes. What I would tell you is also look at the trend line using the closes. So if I take the close and the close here, so I'm using the close from October, I'm using the low close here from early January, late December, you can see that actually lines up just currently above where we closed today. So I think we're right at that level, the 200-day, this trend line using the closing prices. We closed below those levels, so close below 39.40 next week. I think sets us up for a potential retest, certainly of the December lows, if not even further. But I think the market's now at a non-zero risk of going down. If we were to hold and if we were to maintain this sort of bullish thesis, sort of recovery story off the October lows, we got to start holding levels here. And I think we're right at that point where we need to hold it. Let's go to chart number 2. Mention the phenomena stocks. I didn't have time in our market update, our wrap the week segment, to go into depth looking at these stocks, but I'm concerned when I'm looking at the individual stocks that comprise these indexes. Besides the S&P, the Nasdaq testing and potentially failing support, I'm concerned by some of the most important mega cap names being unable to hold support as well. Apple finished the week literally closing almost to the penny on its 200-day moving average. Microsoft very clearly closing below its 200-day moving average for the first time since the end of January. Nothing good happens below the 200-day moving average, is the way one of my early mentors described it to me when he was trying to reinforce the importance of just looking at the shape of the moving averages as a way of assessing the overall conditions. And I took that to heart. And at times I've talked with Grayson Rose here at StockCharts about eliminating price altogether and just looking at the shapes of the moving averages as a way of really clearing your head, getting away from the noise, and focusing on the overall shifts that you see in the market. When I do that, right, and if you just mentally remove the black price data and just look at the blue moving averages, these moving averages are sloping downwards, basically telling you that it's weakness over strength. The fact that these stocks are not able to hold the 200-day, if that's what happens into next week, I think that would be another set of clear check marks in the bearish column. Finally, let's finish the week and finish this show on a high note. Let's look at some areas of the market that are actually doing well. Even though we're talking about the risk of the market going lower, even though we're talking about support levels not holding in some areas of the market, let's remember that some parts of the market are actually doing just fine. Heavy construction is a group within the industrial sector actually doing very, very well. This is the Dow US Heavy Construction Index we're looking at. It includes names like PWR, ACM, Fluor, EMEJ, and others. You can look at our industry summary if you want to know more about the names and look for some of the higher ranked names, large, mid, and small caps. But I'm looking at a chart that is going up and to the right with strong but not excessive momentum and making new relative highs. That's a thumbs up. Pretty strong chart. Folks, that's a wrap for this week. I want to thank you so much for joining us every weekday after the close. All of our previous interviews can be found for free at StockChartsTV.com. I'm Dave Keller with StockCharts. Be well. Have a great weekend. We'll see you on Monday. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.